Yellen's saying she has full confidence in the banking regulators. The FDIC has come in, taken control at Silicon Valley Bank and will oversee the sale process. Do you have that confidence based on your experience in this area?
I do. Look, the FDIC has done a great job in handling and resolving institutions. Actually, generally speaking, they're able to do so at a small cost to taxpayers and tend to recover a lot for uninsured depositors. But each bank failure is a little bit different. Keep in mind, this bank was overseen at the federal level by the Federal Reserve. The Federal Reserve Bank of San Francisco was Silicon Valley Bank's #1 federal regulator. And so the San Francisco Fed should have been on top of what was going on, the bank's explosive growth, and now its very quick failure. But there are a lot of tools the FDIC has to handle this resolution situation. And I do think there's confidence. Look, this is a large bank. 16th largest bank in the country.
Yeah.
But it's not your typical bank. It only has 16 branches. It's a very different structured bank than most of its peers around that same size.
Aaron, just to bring you the breaking news that continues to unfold, we currently understand that SVB Financial Group, perhaps unsurprisingly, is going to be removed from the S&P 500 as an index. Insulet is the company that will replace it. But just talk us through what got us here ultimately and whether the regulations that you have been so crucial in forming in many ways and analysing the repercussions thereof, whether they're the right regulations, the right ways in which banks currently hold capital, but in some ways can lead to extraordinary circumstances that we find with SVB.
Right. So let's start with the premise. My premise is banks should fail. We have nearly 5,000 banks in America, and a healthy amount of failure is greater than zero. I was more concerned the last 2 years when not a single bank failed. Which, by the way, the first time in American history we went a year without a bank failure was 2005. Regulators told us the banking system was in great shape and not a single bank failed again in 06. Oops. So a little bit of failure is actually a desirable thing, not something to be afraid of. The question is when an institution fails, is that failure contained? Who bears the losses of it, and how quickly can this situation be resolved? And in that situation, I think the regulatory tools the FDIC and the Federal Reserve and other regulators have now are light years ahead of what they had in 2007 and 8, when the cause of the crisis was very different.
Aaron, a lot of people out there have a lot of questions, principally startup founders who were banking with Silicon Valley Bank. When the FDIC comes into an institution in this situation, what is their priority? You look at the chart on the screen, you can't even see it on the right-hand side because this is the first technical FDIC failure in a very, very long time, in the first of this year.
So, Silvergate Bank is another bank that failed very recently. If you want to call it a technical failure or not, sometimes the FDIC is able to negotiate purchase and assumptions here where other banks take the assets of the other bank. The FDIC's #1 priority are the retail customers and the insured depositors who are going to be able to have access to their money almost like nothing happened. There's just a bit of a rebranding. That's their #1 priority. Uninsured depositors, businesses, their #2 priority is to try to maximize the ongoing value of the institution to minimize the loss felt by everybody, including uninsured depositors. But I want to point something out here, and I hope we get a chance to discuss it, which is the FDIC isn't the first person to have a claimant.
Yes.
So if you think about who owes to who has a claim on this bank's assets, the FDIC is #2. #1 is this kind of arcane part of the government called the Federal Home Loan Bank system. And the Federal Home Loan Bank of San Francisco had lent more money to Silicon Valley Bank than to any other bank they did business with at its time of its failure.
Okay, so dig in, therefore. You've done analysis on what other companies, what other lenders have perhaps exposure to the home loans element of things. Are we likely to see, what's the contagion risk here? What's ultimately going to be the likelihood of also the uninsured companies, the likes of Roku that comes out and says 26% of its cash balances are over in Silicon Valley Bank and ultimately aren't insured? What are the ripple effects there?
So there are a couple things. #1, the people that run to the home loan bank system that are heavy users of it, particularly that come very, very quick. A year ago, Silicon Valley Bank didn't even appear on the top list of borrowers from the Federal Home Loan Bank of San Francisco. And, within a year, they vaulted to number one, $20 billion of outstanding advances. Silvergate, at the time of its failure, had over $4 billion of outstanding advances. So you look at the list of other people that have started leaning very heavily on the home loan bank system, and you ask the question, why? Why are they going there? Particularly a bank like Silverbank, which isn't really making mortgages, right? The purpose of the home loan bank system originally, when you go back 100 years, it was supposed to be a Federal Reserve kind of for these things called thrifts that used to make mortgages when America had a very different banking system, and a bank and a thrift were different things. So I kind of look there. That's a classic red flag. If you go back to 2007, Countrywide, Washington Mutual, all of those folks were the ones that were running to the home loan bank system in '07, long after the market had started to dry up on the asset that they were overinvested in.